The recession of 2009 has not slowed entrepreneurship, as thousands of jobless Americans seek to turn a bad situation on its head by starting a business. But not only are those entrepreneurs launching their business in tough times, some experts warn they might be doing it for the wrong reasons.
The question is, are those businesses being started up as a result of what we call opportunity-driven entrepreneurship or necessity-driven entrepreneurship?
The recession-fueled startups most likely to succeed are the ones that seize on opportunities created by the downturn itself. Take Fay Financial, a Lincoln Park-based mortgage servicer launched in 2007 at the start of the subprime mortgage meltdown. Fay's customer reps work with homeowners in serious danger of losing their homes to foreclosure. Typically, Fay steps in when borrowers have fallen at least 120 days behind on their mortgage payments. But Fay's not a ham-fisted collection agency or even a typical mortgage servicer. Those outfits usually try to fit distressed borrowers into a government assistance program. If they don't qualify, the servicer just cuts them loose on the road to foreclosure. Founder Ed Fay's theory is that foreclosure is the worst possible outcome, not only for the borrowers, but for his clients, the banks and investors who own the mortgages. To protect both sides from a calamity, he performs a detailed analysis of homeowners' finances and tries to win their trust, so Fay can be among the first to know when something bad happens.
If you lose your job, call your wife, call unemployment, and then call me.
The personal approach is unique among loan servicers, and it's landed Fay contracts worth $1 billion in mortgages from 5 big mortgage holders. He plans to get to $10 billion in the next year and a half. In the coming months, he'll open 2 more call centers in Minneapolis and Phoenix, each staffed with about 50 reps, mostly former mortgage brokers, many of whom worked in the very subprime shops that caused the housing crisis. A former All-American in lacrosse, Fay himself came up through the big mortgage lenders. Before striking out on his own, he worked at HSBC, Household International, and Countrywide Financial, churning out mortgages for thousands of American homeowners. It was there, back in 2002, with home prices going up 10 to 15% a year across the country and debt-to-income levels nearly double their historical levels, that Fay says he saw a crisis looming, even as most of the mortgage industry assumed the good times would last forever.
When you have national appreciation of 10 to 15%, I saw it as a problem. One of the bigger problems was everyone else saw it as it was just an institutionalized thought that it made sense and it worked. And really what happened at that point is I started working on what was going to happen if it was a bubble and what was going to come down.
In 2007, with the housing bubble about to burst, Fay left Countrywide, raised $10 million, and launched a fund to buy bad mortgages on the cheap, knowing that underwriters and investors would be unloading their housing portfolios to raise cash and get the bad debts off their books. He was right about that, but as he went about managing the loans he had bought, Fay discovered something he hadn't anticipated. The companies he hired to service the loans were letting too many slip into foreclosure, and Fay knew that foreclosure usually meant a loss of at least 30% and sometimes as high as 75% for the lender. So he built his own servicing operation, hiring sophisticated customer reps who could work with homeowners to keep them paying, even a few dollars a month, until they could either get back on their feet and make the full payment or sell the house and move on. Fay's team developed a 5-page financial analysis that it ran for every homeowner. It was based on an observation Fay had made during his days selling mortgages, that most people had no idea how much they were spending every month. Fay's reps drilled down. So rather than simply asking what borrowers spend on their cars, Fay asks how far they drive to work, how often they drive on weekends, and what they spend on insurance and oil changes. That analysis is the closest thing Fay has to a proprietary formula. As Fay says, it's not like he's trading derivatives.
The way I explain it to my staff is what we do isn't hard, rocket science hard. It's hard digging a ditch hard. What we do is not easy. We have to dig in, go through a customer's personal situations. Oftentimes it's the worst time they've ever had in their life, where they're dealing with this financial calamity around their family. And we're trying to be there to be helpful in the process, because frankly, it just works better.
In late 2007, Fay made the decision to turn his servicing arm into a full-blown business. This year it will bring in about $1.5 million in revenue, which comes from a percentage of the payments Fay collects or some other fee tied to modifying and servicing the loans. Fay isn't concerned that business will drop off as the housing crisis eases. With delinquent loans piling up on banks' balance sheets, he doesn't see any end in sight. And while that's bad for the overall economy, it bodes well for Ed Fay's recession-fueled business.
We had a calamity in the overall markets, and I happened to be at the epicenter of it, and was able to really, I think, understand what was going on and what some of the solutions were for that. And at that point, I decided to go for broke and starting my own company.